Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, we begin in Asia. Asian equities have surged to their first record high in more than 4 years, underscoring how reduced reliance on China and a broader suite of growth drivers are leading staying power to the rally. The MSCI Asia Pacific Index has climbed 22% this year to reach its all-time high, outpacing both the S&P 500 and the Stoxx Europe 600. While US stocks have been buoyed by the artificial intelligence boom and expectations of Federal Reserve rate cuts, Asia's performance has been even stronger, propelled by multiple sources of strength across the region. India's economic momentum, Taiwan's dominance in semiconductors, and Japan's corporate reform agenda have together grown global funds away from a China-centric bet into a more diversified mix of winners. The new balance has tempered bubble warnings that were widespread during the last peak nearly 5 years ago. Valuations remain relatively modest, earnings are accelerating in technology supply chains, and governments across the region continue to provide policy support. China remains systemically important, and a rebound in its long-lagging internet giants has been a significant contributor to the rally. Yet the composition of the Asian benchmark has shifted notably. China's weighing in the MSCI Asia Pacific Index has fallen to 16.4% from 20.7%, while Hong Kong's share has nearly halved to 5.5%, reflecting property sector stress and geopolitical headwinds, spaces we've been following very closely on my other channel, China Update. Meanwhile, India's weighing has nearly doubled to 10.7% thanks to reforms, a burgeoning middle class, and rising local inflows. Taiwan has risen to 12.6% from 8.9%, cementing its status as a hub for global semiconductor production. Japan too has gained ground on the back of governance reforms, a weaker yen, and foreign investor inflows. Indeed, Tokyo stocks broke another record yesterday, Tuesday, the 8th in under 2 months, and passed the 45,000 mark for the first time ever, before falling back somewhat. One potential vulnerability is increased concentration risk. Taiwan Semiconductor Manufacturing Co., TSMC, the world's leading chip foundry, now accounts for 6.8% of the index, up from 4.3% at the last peak, demonstrating its outsized role in powering the AI era. By contrast, Tencent and Alibaba have seen their influence diminish amid regulatory curbs and uneven earnings. Still, recent catch-up gains in Hong Kong's technology stocks and South Korea's AI-driven surge have bolstered sentiment. The Hong Kong index has jumped more than 30% this year, coming off lows, while South Korea's Kospi has soared over 40%, leading global benchmarks. Chinese technology stocks listed in Hong Kong jumped to their highest level in almost 4 years. The Hang Seng Technology Index rose as much as 2.8% today, Wednesday alone, hitting its highest level since November 2021, but of course still well below the high before that. The gauge is now set for its 7th consecutive week of gains, helped by easing tensions between China and the US, as well as hopes that technology companies' big bets on AI will pay off. Together with Taiwan's technology strength and India's structural growth story, these advances have helped lift Asia to a new record, this time one built on broader foundations. Next up, we move to North America. Bond traders are ramping up options wagers that the Federal Reserve will deliver at least 1 half-point interest rate cut across this year's 3 remaining policy meetings. Policy makers are widely expected to trim borrowing costs on Wednesday, today, for the first time in 2025, with a quarter-point reduction seen as the baseline move. Yet a cooling labour market has prompted some investors to hedge against the possibility that worsening conditions force the Fed into larger, more aggressive cuts before year end, even as inflation remains stubborn. Recent trading linked to the Secured Overnight Financing Rate, SOFR, a benchmark highly sensitive to Fed expectations, shows a surge in demand for December options. These contracts, which expire just 2 days after the Fed's December 10th decision, position investors to profit from as many as 2 half-point cuts or 3 quarter-point reductions across the September, October, and December meetings. That path would exceed the roughly 70 basis points of easing currently priced into swaps. The wages highlight a dovish tilt at odds with market consensus, though they carry clear risks should Fed Chair Jerome Powell deliver a cautious message on Wednesday, today, particularly with the inflationary impact of new tariffs still unclear. Such bets could unwind quickly. Standard Chartered economists, for instance, are calling for a half-point catch-up cut this week, but caution that Powell is unlikely to commit to a sustained easing cycle given diversions among officials. The policy speculation has also fueled momentum in gold. Bullion briefly touched a fresh record of 3,703.07 an ounce on yesterday, and was trading just below that level on Wednesday morning in Asia. Gold has gained more than 40% this year, buoyed by expectations of looser monetary policy, ongoing geopolitical tensions, and persistent central bank buying, particularly from emerging markets, all signs of pessimism looking forward. Goldman Sachs has forecast the rally could carry prices toward $5,000 an ounce. A weaker dollar has added support, with the Bloomberg Dollar Spot Index slipping to its lowest since early 2022. Lower US yields reduce the appeal of greenback and strengthen demand for non-yielding assets such as gold. Silver, meanwhile, held just shy of its highest level in 14 years. Political tensions are further shaping the narrative too. For now, traders' attention remains squarely on Powell's press conference today, which could set the tone for both bond markets and precious metals through year end. We'll be following this meeting and its implications for the global economy closely too. If you want to stay on top of the most up-to-date analysis on the biggest markets around the world, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. Next up, and finally for today, let's end with some positive news for the UK. This is to supplement what we discussed in yesterday's video. US technology heavyweights Microsoft, Nvidia, Google and OpenAI have pledged to invest tens of billions of pounds in computing infrastructure in the UK as Prime Minister Sir Keir Starmer and US President Donald Trump unveiled a sweeping technology partnership. The largest single commitment comes from Microsoft, which announced a $30 billion artificial intelligence investment through 2028, with about half directed to British cloud and AI infrastructure. Central to this effort will be the construction of the UK's largest supercomputer, equipped with 23,000 Nvidia AI chips and hosted by London-based data center operator Nscale. Microsoft President Brad Smith said the commitment was unthinkable a few years ago given the UK's tougher regulatory climate, citing the long battle over its $75 billion Activision Blizzard acquisition. The announcement coincided with Trump's arrival in Britain late yesterday, for an unprecedented second state visit to the country. Starmer cast the agreement as, quote, a decisive step toward the UK becoming a world leader in AI, end quote, with officials drawing parallels to the so-called special relationship historically centered on defense and security. The investments mark a reversal of the UK's AI standing after Nvidia chief Jensen Huang criticized its lack of infrastructure at London Tech Week in June. Nvidia now says its Blackwell chips will anchor a 120,000 unit cluster in Britain by the end of 2026, the largest such concentration in Europe. Huang hailed the UK's, quote, Goldilocks position, end quote, where talent, research and industry converge. Other US giants also pledged major resources. Google will spend £5 billion over the next 2 years, leveraging the country's DeepMind research hub. OpenAI, led by Sam Altman, will partner with Nscale to build data centers for its Stargate project in a new so-called AI growth zone in northeast England. Nscale and CoreWeave, another US cloud operator, together plan more than £11 billion of AI computing developments extending beyond UK borders. All these investments are expected to boost the UK capacity while deepening trade discussions. Trump said that his trip was, quote, primarily, end quote, a meeting for King Charles and Queen Camilla, but acknowledged ongoing talks over steel tariffs. Starmer is pushing to lock in a 25% rate on UK exports, half the level imposed on other countries, though short of the original duty-free quota envisioned under prior agreements. Despite the optimism, trade trade groups warn hurdles remain. The Computer and Communications Industry Association flagged unresolved disputes over UK online safety rules, competition enforcement and digital taxes are potential sticking points for Washington. For now, however, with the UK facing serious fiscal issues we've been following closely on Market Update, these large-scale investments are a piece of good news. And if implemented, would put the UK in a leading position in not just Europe, but globally when it comes to this new era of AI competition. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Wednesday, and I will see you for another episode tomorrow.